Okay, welcome back to the middle of cash flow statement. We are on page 7 and we're starting with the investing activities. Okay, so as we were in operating activities, we looked at current assets, current liabilities, and non-cash on the income statement. Okay. In investing activities, this is all the long-term assets. So pretty much when you've done all the sections, you've done all the pieces of the balance sheet and the income statement. So if long-term assets increase, that means you got more of them. So we subtract the amount spent in this section. Okay, and remember it's just the dollars. And if they decrease, what must we have done? Sold them. So we add the amount received because we've received cash. So call this a source of cash. It would be a use of cash. Now, significant non-cash transactions should be disclosed in notes outlining the transaction. So purchase of building and land by assuming a mortgage should be disclosed in notes to the statement. So basically you put a sentence at the end of the statement. Now, financing activities. We've already used up long-term assets. We've used up current assets, current liabilities, and the income statement. So what's left on the balance sheet or income statement? Well, long-term liabilities, short-term notes payable, so this is an exception. It's a current liability. And loans and shareholders' equity. So, if your liabilities or your notes, your short-term notes payable, increase, did you get money? Yeah, because if you went and got a loan, your bank account increases. And so you would add them to this section because they represent an inflow or source cash. If they go down, we paid some off, some of the principal. So we subtract them because they represent a payment or an outflow of cash. If share capital increases due to an issuance of shares, add the cash generated. If it goes down because we repurchase some, subtract the amount cash used. Cash dividends directly to retained earnings appear in financing activities and are subject because they use cash. So this one, that's why I say I always keep the dividends paid in financing unless it tells me otherwise. Temporary bank overdrafts belong with cash and cash equivalents, so it reduces them. But they can also appear in the financing section instead as a source of cash when used and a use of cash when paid off. So you can either, you know what an overdraft is, right? Most companies have them, lots of individual consumers have them. You get down to zero in your bank account, temporary overdraft is like a short-term loan kind of that you can dip into if you need to. So you might have a $1,000 overdraft. When you're using it, it's a liability. So if it goes up, you get cash, but when you pay it off, when your next pay comes or whatever, that will be a use of cash. So a source when used, a use when paid off. Again, cash and cash equivalents is where you use this. So they'd be up at the bottom of the statement. Okay, on page 8 then, the financing portion of third-party non-cash transactions is included here as a source of cash. So let's say you got a mortgage from the bank. Here's our company, a bank, and our building owner. We're buying a building. Okay? We would get the building. The bank would give us the money, or transfer directly. To the building owner. Either way, you notice there's 3 people involved. When this happens, you include the mortgage payable would go to financing, and it would be a source, and the building purchase would go to investing, and it's a use. If there was no one involved, let's say we had paid with shares. So we just exchanged shares. Shares for building. Then it would just be a note. Okay. Now, one portion of the statement. So we have operating activities, investing activities, financing activities. The last little piece, the last 3 lines look like this. Change in cash and cash equivalents. So if we had the 3 pieces, we have operating, investing, financing. 2, 3. You would add 1 plus 2 plus 3. Then you'd add your beginning cash and cash equivalents balance, or subtract, whichever. It depends on how you net it out. It's generally added. Then you get the ending cash and cash equivalents balance. This 1, 2, and 3 does not have to be positive. Oh, I cannot write. I'm so sorry. And hopefully your ending cash and cash equivalents balance should match cash and cash equivalents in the most recent balance sheet. So, the way you actually do the statement: you calculate the increase or decrease in each balance sheet account. Compute the necessary data for sales of assets, because often they leave little pieces out, like don't tell you how much of the equipment you sold. They did tell you how much you bought, or they tell you what the accumulated depreciation is, and you have to find depreciation expense, all kinds of things. And for sure you did that in intro. That's the tricky part right there. And calculate the change in RE. Given, sometimes it's not. Net income makes RE go up, and dividends make it go down. That's why it's in brackets. Generally, we put it in brackets so it's negative. Okay, so those 2 will be the change in RE. So sometimes they'll give you this and this, but not this, or they'll give you this and this, and you have to figure that out, all kinds of things. So really, you This, out of all the kinds of questions that can look different, is this one. The statement of cash flow, because it is the trickiest. And there's so many different scenarios. So then you're going to decide which section each of the changes in the balance sheet accounts, the pertinent items on the income statement, and the additional information belongs. Then these two steps are the hardest. This one, when you made all these calculations, it's pretty straightforward. So this just follows a format. Okay, so I'm going to end this video here. What I want you to do before you go on to the next video is read through this example on page 8, 9, and then 10 is just where we're going to do our work. So take a little break, read page 8 and 9, try and think about it. And then we'll start on the next video. Okay, see you shortly.